Apart from today's late-day pullback, markets have been racing higher to end 2023. But could the latest geopolitical developments in the Red Sea and elsewhere pose a threat to investors and to the Fed's rate cut timeline? Well, joining us now is RockCreek's founder and CEO, Afsaneh Beschloss. Afsaneh, it's great to have you back on the show, and that's exactly where I want to start, because in addition to all the focus right now on what's going on in the Red Sea and the potential impact there to supply chains, just earlier today, NBC reporting that China's President Xi, apparently at the APEC summit, warned President Biden that Beijing will reunify Taiwan with China, although the timing, at least according to this reporting, was not determined or at least not outlined. Geopolitical risks. How should investors be thinking about this going into 2024?
So, Morgan, we just put out RockCreek's top 10 trends for ending 2023. And on top of it is exactly what you said, which is the very heightened geopolitical risks. And we see VIX is up, right? The uncertainties in the world are so much higher. You mentioned the U.S.-China conflict and the issues that remain to be resolved, whether it's Taiwan or whether it's the microchip war. The big issue, though, is what we're seeing with the continuation of the Ukraine war, with the potential expansion of the Middle East war now with these Houthi attacks. Obviously, we hope that the U.S. response and the allies' response will keep them in check. But we should not get surprised every morning when we open our eyes and we look at the markets that you don't have a surprise, whether it is Venezuelans looking at Ghana or another kind of a Houthi attack.
And of course, all of this injects a certain amount of uncertainty into economic modeling as you look to 2024 as well. And as we know, when you see these types of conflicts or tensions arise, they have a tendency to present inflationary impact, whether it's fully realized or not. But I mean, just this week, look no further than what we saw with energy prices and oil starting to tick back up a little bit. So what does it mean for the Fed as it does have a forecast that includes potential rate cuts next year?
So we had the Santa Claus rally since we heard from Jay Powell, and I think we're seeing a little bit of a correction today. But the bigger issue is exactly what you said, which is that with potential risk and with potential supply chain issues that we're seeing, also because terms of trade are changing. There's two straits through which a lot of trade happens. We're now seeing the Red Sea problems. Other ones are getting affected by climate change and less water. So we have a lot of issues that are going to impact trade and impact supply chains. So we can't just forget what happened, I think, about a year ago, where all we talked about was supply chains, to completely forget about them. So I would expect that while a lot of people expected following the Fed talk that rates would come down faster and in larger amounts, that in fact those rate cuts might be later in the year and maybe even smaller.
Okay. Afsaneh, good to see you. Great to have you back. International stocks, with the exception of Japan and India, really underperformed this year. So if that changes in 24, what geographies do you think will lead?
So, of course, as you said, Japan was up 27%. I expect that Japan will still continue to do well. They're getting the advantages of what is the move towards EV and batteries. They're getting the advantages of China slowly doing a little better. So they're still beneficiaries in terms of their economy. Their wages are going up. So I think Japan will continue to do well. You mentioned India. I think India also is expected to continue doing well with their move towards a greener economy, but also faster growth and better economic policies. In terms of the rest of the world, I think within emerging markets, potentially some of the LATAM countries could be continuing to benefit, again, from the nearshoring and some of the trends we saw this year, and that could continue. The big question is Europe. We saw with the UK CPI numbers being a lot better than expected. There could be a potential, since Brexit, UK has really got killed, and UK equities have got killed. There could be good news, particularly in stocks in Europe that benefit from the trends in the rest of the world.